Welcome to Quick Bite, your fast and friendly Florida insurance.
Hello. This is Roshonda, agency owner of the Isom Insurance Group, here in the Sunshine State of Florida, back again with another Quick Bite episode, your fast and informative insurance market update. Today is Saturday, August 22nd, 2026. And we have another earnings call. Liberty Mutual just reported $2.6 billion quarterly net income and an 86.4% combined ratio. But one of the most important numbers moved in the opposite direction. Its underlying combined ratio worsened as expenses climbed. So are these results as strong as the headlines suggest? And what do they tell us about auto insurance, homeowners insurance, independent agents, claims, pricing, and artificial intelligence? In today's Liberty Mutual Insurance Review, we are breaking down the company's Q2 2026 and first half earnings call. I'll pause the recording at 14 exact points so we can talk about the numbers, what management emphasized, and what the results may mean for insurance agents and consumers. Remember, a combined ratio below 100 generally indicates an underwriting profit before investment income. The further below 100, the stronger the underwriting results or margin. But we still have to understand what created that result. So let's begin with the call.
Good morning, ladies and gentlemen, and welcome to the Liberty Mutual First Half 2026 Earnings Conference Call. While this call is available online at the URL included in the Liberty Mutual Insurance press release, analysts should participate by phone in order to ask a question. To ask a question, you may press star, then 1 on your touch-tone phone. If you are using a speakerphone, you must pick up your handset before pressing the keys. To withdraw your question, please press star, then 2. Please note, this event is being recorded. To begin Liberty Mutual's presentation is Robert Peach, Executive Director, Investor Relations and Capital Markets. Mr. Peach?
Good morning, and welcome to Liberty Mutual's first half 2026 earnings call. Our earnings release and financial statements are available on our Investor Relations website. Joining us today are Tim Sweeney, Chairman and Chief Executive Officer, Hamid Mirza, President, U.S. Retail Markets, Vlad Barbalat, Chief Investment Officer and President, Global Risk and Capital Solutions, and Julie Haas, Chief Financial Officer. Following prepared remarks, we'll open the line for Q&A, where we will be joined by Matthew Moore, President, Global Risk Solutions, and co-presidents of Liberty Mutual Investments, Adam Wynn and Patrizio Urcioli. Damon Hart, our Chief Legal Officer and Secretary, is also with us today. As a reminder, today's discussions may contain forward-looking statements that represent the company's beliefs concerning future operations, strategies, financial results, and other developments. Actual results may differ materially from those expressed or implied. Please refer to our website for a complete discussion of the risk factors related to this presentation and the company. The company does not intend and does not undertake any obligation to update these forward-looking statements, which speak only as of today's date. I will now turn the call over to Tim for his opening remarks. Tim?
Thanks, Rob, and good morning, everyone. I'm pleased to report that Liberty Mutual has delivered another strong start to the year with meaningful contributions from all three of our businesses. Net income attributable to LMHC was $4.7 billion through the second quarter, and our consolidated combined ratio was 87.3%, a 4.6-point improvement from the prior year. Net written premium was $22.2 billion, an increase of 1.1% as we look to pursue disciplined growth where we feel well positioned to do so profitably. These results are a direct reflection of the
Sorry, my mic was muted. The opening numbers are strong. Management reports $4.7 billion of net income for the first half, not just the second quarter. and a first half consolidated combined ratio of 87.3%. Net written premium reached $22.2 billion, up 1.1%. That combined ratio means Liberty Mutual spent roughly 87 cents on claims and underwriting expenses for every premium dollar earned before investment income. Management ties the improvement to higher underwriting, risk selection, and its order of priorities: integrity, profit, and then growth. My first takeaway is that Liberty Mutual is telling us it will not chase policy count simply to look larger. It wants growth only after the risk has been priced to its return target. Now let's continue the call.
Fine risk selection and generate capital to support the needs of our policyholders. The first half extends the momentum we've built over the past 2 years and reinforces the deliberate choices we've made consistent with our mantra: integrity, profit, and then growth. We have moved from restoring profitability to building a company that is well-positioned to deliver consistently through changing market conditions. We are encouraged by our recent results and will continue to focus on durable underwriting performance, disciplined capital management, and profitable growth over time. The most encouraging aspect of our performance is the breadth and consistency of execution. Across Liberty Mutual, our teams continue to focus on risk selection and pricing, managing expenses, and making more deliberate decisions about where we deploy capital. As you will hear from our business leaders in a few minutes, our diversified portfolio and shared operating discipline are producing stronger and more consistent outcomes. Our progress is first and foremost a reflection of our people and our partners. We are building capabilities that help them make better, faster decisions. Artificial intelligence is an important part of that work, but not as a standalone initiative. We are embedding AI into our platforms and workflows to improve underwriting insights, accelerate claims and service processes, and support greater efficiency across functions. We are scaling deliberately with strong governance, model validation, data protections, and human accountability. The objective is to augment professional expertise and judgment, not replace it. The external environment remains dynamic. The personal and commercial markets are evolving differently. Conditions are not uniform, but our response is consistent across the enterprise. Maintain underwriting discipline, protect the quality of the portfolio, and pursue growth only where expected returns meet our thresholds. Inflation has begun to moderate, but repair, medical, and wage-related severity remains elevated in selected areas. Weather volatility continues, and legal system abuse remains a meaningful headwind for the industry, particularly in liability lines. Interest rates, asset values, affordability, and business activity can also influence customer behavior and loss trends. Improved industry profitability should not be mistaken for a lower cost of risk, and we will remain vigilant on pricing adequacy, reserving, claims execution, and risk concentration management.
This section of the call contains two messages. First, Liberty Mutual is embedding artificial intelligence into underwriting. Just like a lot of companies, we all know that artificial intelligence is very heavily being used in insurance. So the artificial intelligence is being embedded into underwriting, claims, and service workflows. Management says the goal is to improve decisions and efficiencies while keeping governance, validation, data protection, and human accountability in place. Second, the company is not declaring victory over loss costs. Repair costs, medical costs, and wages remain elevated in selected areas, and legal system abuse continues to pressure liability claims. That matters for auto bodily injury, commercial auto, general liability, umbrella type exposures. For consumers, profitable insurer results do not automatically mean every renewal will decrease. Your individual rate still reflects your state, territory, vehicle, home, claims history, coverage, and the insurer's current pricing plan. Now, let's return to the earnings call.
Source of strength. With total equity of $44 billion at quarter end, financial strength that is foundational to how we protect our policyholders. Our capital exists first and foremost to support the promises we make, absorb volatility, and ensure we can be there for customers when they need us most. It also gives us the flexibility to invest in our businesses and manage through the insurance cycle from a position of strength. As we work to become the preeminent insurance and capital solutions partner, we will continue to protect our balance sheet, maintain ample liquidity, invest behind attractive risk-adjusted opportunities, and prudently manage our capital. That ambition is reflected in the leadership structure we announced in April with the appointment of Vlad Barbalat as President of Global Risk and Capital Solutions. Vlad now has strategic oversight and accountability for our goals across Global Risk Solutions and Liberty Mutual Investments and what we see as a convergence of opportunities. The two businesses will retain clear operating accountability and are not being integrated. Instead, we are deliberately aligning capabilities that share a common foundation, underwriting risk and deploying capital into uncertainty. By connecting our risk, capital, investment, and technology capabilities more closely, we believe we can move faster for customers and partners and pursue a broader set of attractive risk-adjusted opportunities while maintaining disciplined capital allocation and the financial strength that protects our policyholders. At the midpoint of 2026, I couldn't be more pleased with our results. We are building on a much stronger foundation than we had 3 years ago and have set a clear and compelling direction for our company. The next phase will require us to compete for attractive growth as personal lines margins normalize, navigate a softening commercial market without compromising underwriting standards, and continue improving claims, expense management, technology, and capital efficiency across the enterprise. We remain confident in our ability to perform through the cycle, protect our policyholders, and build Liberty Mutual into the preeminent insurance and capital solutions partner. With that, I'll turn the call over to Hamid for a discussion of U.S. retail markets.
Thank you, Tim.
Liberty Mutual says total equity was approximately $44 billion at quarter end. Management presents that capital as protection for policyholders, a buffering against volatility, and a source of flexibility to invest through the insurance cycle. The company is also aligning Global Risk Solutions and Liberty Mutual Investments under broader strategic oversight. Management is careful to say the two businesses are not being merged. The goal is closer coordination among underwriting risks, capital investments, and technology. The forward-looking challenge is clear. Compete for attractive personal lines growth as margins normalize while navigating a softening commercial market without weakening underwriting standards. Now, let's jump back into the call.
Continues to deliver consistently strong profitability with a 2026 year-to-date combined ratio of 82%, an 8-point improvement over 2025. Pre-tax operating income reached $3 billion, up about $1 billion year over year. These results reflect continued tailwinds from disciplined underwriting and book mix, favorable non-catastrophe trends, prior year development, and lower catastrophe losses. Our net written premium decreased 1% in the first half of 2026, driven by underwriting actions we took to build the right portfolio by line, transformation of our exclusive agency channel into an independent agency called Comparion, and purposeful action to reduce our average written premium. We achieved sequential quarterly policies in force growth in both auto and dwelling, our lead lines, during the first half of 2026. Excluding California, our lead lines also achieved year-over-year PIF growth. This is driven by a substantial increase in new business year over year, as well as a 6-point increase in retention. I'll speak to our performance in each of our 4 segments, starting with dwelling, which represents roughly 90% of our personal property business. First half 2026 dwelling results were very strong, with a 69.5% combined ratio through June. Dwelling profitability was aided by low cat activity as well as non-catastrophe weather frequencies, which continue to emerge at levels below historical norms. In addition, severity trends were also relatively flat. To date, geopolitical impacts have not emerged as material drivers of property loss trends, although some macroeconomic indicators have risen recently. From a growth perspective, dwelling PIF, excluding California, grew almost 1 point over Q1 2026 and 2 points compared to Q2 2025. Our personal auto segment also delivered strong first half results, ending June with an 88.2 combined ratio. Physical damage frequency trends have moderated, with trends in line with longer-term historical decreases. Physical damage severity trends increased slightly, driven by increasing part prices, while auto liability loss trends remained in the high single digits. We also saw continued favorable prior accident year development within liability lines. From a growth perspective, auto PIF, excluding California, grew 1 point over Q1 2026 and nearly 2 points over Q2 2025. Our U.S. small commercial segment has continued 2025's profitability, concluding June with a 94.7% combined.
Okay, so let's break down that section. U.S. retail markets, strong profit, lower premiums. So the overview, U.S. retail markets reports an 82% first half combined ratio and approximately $3 billion of pre-tax operating income, which comes out to be about $1 billion higher than the prior year. Those are very strong profitability figures, but net written premium declined about 1%. Management attributes that to underwriting actions, the conversion of the exclusive agent channel into the independent agency business, Comparion, and deliberate reductions in average written premium. This is an important distinction. Lower premium does not necessarily mean the company is losing control of the business. Liberty Mutual says new business and retention improved with policy growth in auto and dwelling outside of California. And then another theme that came up was about dwelling. The company's largest personal property line, reported a 69.5% first half combined ratio. Management says the result benefited from low catastrophic activity, non-catastrophic weather frequency below historical norms, and relatively flat severity. Excluding California, dwelling policies in force improved consecutively and year over year. Personal auto reported an 88.2% first half combined ratio. Physical damage frequency moderated while parts prices pushed severity slightly higher. Auto liability loss trends remained in the high single digits, and the company also benefited from favorable developments on prior accident years. The consumer takeaway is mixed but encouraging. Liberty Mutual sees room to grow, yet bodily injury and liability costs remain major reasons auto insurance pricing cannot be judged by vehicle repair trends alone. Now let's pick back up on the call.
Severity trends on liability lines remained. Perspective, auto PIF, excluding California, grew 1 point over Q1 2026 and nearly 2 points over Q2 2025. Our U.S. small commercial segment has continued 2025's profitability, concluding June with a 94.7% combined ratio. Severity trends on liability lines remained elevated due to continued pressure from legal system abuse, though with some early signs of moderation in recent accident years as attorney representation and litigation rates stabilize. On property, continued negative frequency trends across all perils continues to drive favorability, with the most substantial benefit from crime perils. Workers' compensation frequency trends remain stable and are partially offset by severity pressure from large losses. And finally, our independent agency Comparion continues to deliver market-level margins with additional gains above prior year profit. As previously discussed, Comparion has emerged as one of the largest personal lines agencies in the US, and we are truly excited by this transformation as we believe in the independent agency model and the lasting value it provides, making insurance easier, offering meaningful choice, and delivering trusted advice to our policyholders. We've built an adaptable and resilient business that is well positioned to succeed in a dynamic and challenging environment. Focused execution against our strategy will help us continue to deliver strong results. And we will continue in our unwavering commitment to our policyholders, agents, and to our people. As we look to the second half of 2026, we remain confident in our ability to manage through an increasingly softening market. Now, I'll turn it over to Vlad to share the results of GRS and LMI.
Thank you, Hamid, and good morning, everyone.
U.S. small commercial finished the first half with 94.7% combined ratio, profitable but not nearly as strong as the personal property result. Liability severity remains pressured by legal system abuse, while workers' compensation experienced some severity pressure from larger losses. Management then emphasizes Comparion, its independent agency. Liberty Mutual says it believes in the independent agent model because it can provide choice and trusted advice. That is strategically important. Liberty Mutual is keeping both direct distribution and independent agency distribution as core channels. For agents, the message is that Liberty Mutual views advice and choice as valuable, but it will still demand market level margins from the distribution business. In the effort of full disclosure, here at our agency, we do offer Liberty Mutual products through the independent channel. Now let's jump back into the call.
Global Risk Solutions, and then turn to LMI. The market is soft and getting softer, driven by abundant capital in both traditional and alternative forms, and a light run of recent catastrophe losses. The pressure is uneven across all our product lines, and our diversification lets us grow well-priced risk even as broad competition intensifies. We make two choices deliberately: where we grow and where we pull back, and how much risk we retain on our balance sheet. Our overall premium growth is an outcome of these choices. Our objective is to be there for our customers and our business partners through the cycle, and to do so while deploying our capital efficiently to earn an appropriate underwriting return. I'll cover the market, our results, and how we are managing the book. In terms of trends, property and property reinsurance are decelerating fastest, and financial lines are soft as well. U.S. casualty is the exception, where rate continues to rise, but not, in our view, to adequate levels. Legal system abuse keeps loss cost trend elevated, and where rate increases fail to keep pace, we have been willing to shed significant risk exposure. Through June, our total combined ratio was 94.2%, up 2.2 points year over year, and our underlying combined ratio was 90.9%, up 3.3 points. As a reminder, our combined ratio reflects a book diversified across product and geography, including Asia retail businesses that carry structurally higher combined ratios than our commercial lines. Three things drove the higher underlying ratio. Current year loss activity was higher as pricing ran below loss cost trend, and non-catastrophe property losses were elevated. Employee costs rose alongside continued investment in technology to accelerate our modernization. And commissions were higher on the business mix. Higher earned premium partly offset these. Catastrophe losses improved 1.2 points to 3.5 points of the ratio, as last year's California wildfires did not recur. Prior year development was modestly favorable, broadly in line with last year. Segment pre-tax operating income was $1.3 billion, down 9%, and underlying pre-tax operating income was $1.5 billion. Net written premium grew to $9.4 billion, up $398 million, or 4%. Growth was led by credit, casualty, financial lines, and sharing economy, together with favorable foreign exchange, partly offset by lower property rate and last year's sale of our Thailand operations. Renewal rate change was negative 2.7%, and overall pricing was down 1.1%. Retention held at 88.3%. New business rose $211 million over the prior year, led by North America and LII. As I said earlier, our posture remains consistent, and our broad suite of products provides a diversification required for us to continue to grow our business where pricing remains adequate. We are growing credit, non-U.S. casualty, and mid-market and small account cyber. In U.S. casualty, we are pushing rate with strong increases in auto, excess and commercial package liability in response to legal system abuse. Risk retention is a deliberate choice for us. We use assumed and ceded reinsurance to set how much risk we hold on our balance sheet to protect earnings and to manage our capital as the market moves. We review our reserves regularly and recognize emerging loss trends promptly, adjusting as those reviews indicate. In short, GRS is performing well, and with the required discipline as the market softens. We are growing where price covers risk, managing how much we retain on our balance sheet, and recognize loss trends promptly. Now shifting to Liberty Mutual Investments.
So Global Risk Solutions says the commercial market is soft and getting softer. Property reinsurance and financial lines are decelerating most quickly. U.S. casualty pricing is still rising, but management does not believe it is keeping pace with the cost of the legal system abuse. The segment's first half total combined ratio was 94.2%, up 2.2 points. So that's not, it's still below 100, but we're still getting really close. And remember, that's 94 cents of every dollar they're taking in, they're spending on underwriting and costs. So you always want that number to be below 100 as you can be. And its underlying combined ratio was 90.9%, up 3.3 points. Pre-tax operating income fell 9%, while net written premium grew about 4.4% year over year. The strategy focuses on selective growth in credit, non-U.S. casualty, and cyber, alongside rate increases for U.S. auto, excess, and commercial package liability. Additionally, Liberty Mutual is shedding risk while pricing is not sufficient and using reinsurance to stabilize capital and earnings. Now let's return back to the earnings call.
To start 2026, building on the momentum from the second half of 2025. Year to date, we generated $3.5 billion of pre-tax investment results, up more than 40% over the first half of 2025. These results reflect elevated all-in yields, idiosyncratic gains on our private portfolio, and continued discipline in how we manage the book. As I have said before, we are not in the business of predicting the future. We are in the business of being prepared for every eventuality. That was on full display to start the year. Geopolitical shocks, tariff and trade policy developments, shifting cyclical conditions, and corresponding changes in the Fed's stance all challenged the expectations we came into the year with. Across public markets, spreads widened meaningfully early in the year, and we leaned into that volatility with high conviction trading and risk selection. As spreads tightened through the second quarter and valuations richened, we took a more measured stance, reducing overall risk while continuing to add exposure selectively in high-quality sectors and individual credit opportunities. Portfolio yield in public fixed income was 4.7% at quarter end, up from 4.5% at the end of 2025, supported by a 4.8% average purchase yield. The rise in interest rates moved the public fixed income portfolio from a $45 million unrealized loss at the start of the year to a $642 million unrealized loss. Turning to private markets, the portfolio was led by our private equity and energy and infrastructure equity strategies, which together generated $1.4 billion of pre-tax income, reflecting strength in venture and digital infrastructure and several portfolio companies completing IPOs. These gains were idiosyncratic, but they were not accidental. We positioned for them through sourcing and underwriting decisions made quarters earlier, and the timing of the payoff was the only part we did not choose. Those same public listings now carry the near-term volatility that comes with holding public equity. Private credit contributed $535 million as our core origination and direct lending franchises generated healthy run rate income across asset-backed and corporate credit, while credit allowances remained immaterial. Through shifting policy expectations and geopolitical and trade uncertainty, our diversified private platform continues to generate attractive long-term returns, supported by strong sourcing, favorable capital pacing, and disciplined underwriting. We do not expect the back half of the year to be any less eventful than the first, as new risks emerge while others fade. Our focus remains on positioning the portfolio to perform across a range of outcomes, balancing return objectives against the risk, liquidity, and duration constraints we must manage to. That approach generates durable income, preserves capital, and meets our commitments through changing markets. It is how we contribute our share of Liberty's ambition to become a preeminent insurance and capital solutions business. And now I'll turn it over to Julie to share enterprise-level results.
Thanks, Vlad.
Liberty Mutual Investments generated approximately $3.5 billion of pre-tax investment results in the first half, and more than 40% above the comparable period. Management credits higher all-in yields, gains in private investments, and active risk selection. The call states the public fixed income portfolio yield was 4.7% at quarter end, while higher rates also increased the unrealized loss on that portfolio to approximately $642 million. An unrealized loss is not the same as selling and locking in the loss, but it still affects reported valuation. Private equity plus energy and infrastructure equity generated about $1.4 billion of pre-tax income, while private credit contributed $535 million. These gains are meaningful, but management itself notes that the timing of private market exits can be uneven. Now let's resume the call.
Mutual's diversified earnings profile and the progress we've made over the past several years. Net income attributable to LMHC was $4.7 billion, up $1.8 billion, or 63% from the prior year period. The increase was driven by significantly lower catastrophe losses and stronger investment results, partially offset by increased expenses. Pre-tax operating income before limited partnerships was $4.6 billion year to date, compared with $3.2 billion in the prior year period. Pre-tax catastrophe losses declined $1.6 billion to $1.0 billion, reflecting lower event activity in the absence of the 2025 California wildfires. We also recognized $384 million of favorable prior year development, down slightly year over year as a result of some incremental reserve strengthening in the corporate segment, offset by releases in USRM from continued favorable development in personal auto. Excluding catastrophes and prior year development, underlying pre-tax operating income before limited partnerships was $5.2 billion, compared with $5.4 billion in the prior period. Improved non-catastrophe loss experience in USRM and higher recurring investment income were more than offset by increased advertising in USRM to support targeted growth, as well as higher current year loss activity and underwriting expenses in GRS. These dynamics are also reflected in our underwriting ratios. The total combined ratio improved 4.6 points to 87.3%, as the catastrophe ratio declined 7.3 points. The underlying combined ratio was 84.3%, 2.3 points higher than the prior year, as a 2.9 point increase in the underwriting expense ratio more than offset a 0.6 point improvement in the claims and claims adjustment expense ratio. Advertising expense added 1.9 points to our underwriting expense ratio year over year. Net written premium totaled $22.2 billion year to date, up $243 million or 1.1%, marking a return to growth at the enterprise level. Growth was led by GRS, reflecting selective expansion in credit, sharing economy, casualty, and financial lines, together with favorable foreign exchange, while personal property also increased. These gains more than offset lower premium in personal auto and small commercial. USRM premium remained below the prior year, largely because of lower average written premium from rate reductions in policy mix, even as new business and retention improved. We remain focused on generating durable, profitable growth while maintaining disciplined return thresholds across the portfolio. Turning to investments, total net investment income was $3.6 billion.
This is one of the most important sections of the entire call. First half net income rose to 63% to $4.6 billion, largely because catastrophic losses fell and investment results improved. Pre-tax catastrophic losses declined by about $1.6 billion to roughly $1 billion. Liberty Mutual also recognized $384 million of favorable prior year development. Personal auto reserve releases in U.S. retail markets helped, while the corporate segment has some reserve strengthening. Now, the key distinction, the first half total combined ratio improved to 87.3% because catastrophic losses were much lower. However, the underlying combined ratio worsened to 84.3%. A higher expense ratio more than offset the improvement in the claims ratio, and advertising alone added 1.9%. 1.9 points to the expense ratio year over year. So the headline, excellent profitability, but the question for the second half is whether growth spending and operating costs translate into enough profitable new business. Now let's get into the ending of the call.
Up $900 million from $2.7 billion in the prior period. Limited partnership income increased $690 million to $1.5 billion, driven by favorable valuations in private equity and equity-based alternative investments, along with higher income from alternative credit investments. Excluding limited partnerships, net investment income increased $210 million, benefiting from growth in the invested asset base, favorable reinvestment rates, and higher alternative credit and other investment income, partially offset by higher investment expenses. Net realized investment losses improved to $56 million from $193 million in the prior year, primarily reflecting stronger equity results, including gains on sales, partially offset by losses on fixed maturity sales and derivatives. Cash flow provided by operating activities was $2.7 billion, an increase of $539 million from 2025, reflecting favorable claim payments offset by higher expenses. Turning to capital management, in April, we issued $750 million of 5.25% senior notes due 2036, our first U.S. dollar benchmark transaction since 2024. Returning to our home market amidst strong investor demand led to exceptional execution, further supporting our capital and balanced debt maturity profile. We ended the second quarter with financial leverage of 17.8%, within our 15 to 25% target range. GAAP equity as of June 30 was $44.1 billion, compared with $39.9 billion at year-end 2025. Statutory surplus was $43.2 billion, compared with $38.9 billion at year-end, primarily driven by $4.7 billion of statutory net income. On July 21st, S&P recognized our improved financial strength and credit quality by upgrading Liberty Mutual's financial strength rating to A+. We believe this action is a reflection of our disciplined capital management, sustained operating performance, and overall financial strength. Taken together, our year-to-date results demonstrate the earnings power of the franchise and the progress we have made across underwriting, investments, and capital. We will continue to pursue profitable growth and invest in the business while maintaining discipline in how we deploy capital. With that, we're happy to take your questions.
We will now.
So let's recap before we get to the questions. First half net investment income reached $3.6 billion, up $900 million. Operating cash flow was $2.7 billion. Liberty Mutual also issued $750 million of 5.25% senior notes due in 2036. Financial leverage ended the quarter at 17.8%, inside management's 15% to 25% target range. GAAP, which stands for Generally Accepted Accounting Principles, these are the standardized set of accounting rules, standards, and procedures that most companies must follow when they compile their financial statements. So according to the GAAP, equity rose to 44.1 billion, and statutory surplus rose to 43.2 billion. S&P upgraded Liberty Mutual's financial strength rating to an A+ on July 21st. That is excellent. Ratings are not a guarantee that claims will always be handled at a certain way, but they are an important indicator of an insurer's ability to meet policyholder obligations. An A+ rating is definitely a good rating, and we like to see that their financial rating is an A or higher. That's really good. That's nothing to scarf about. So let's continue with the call and get into the questions.
The question and answer session. To ask a question, you may press star, then 1 on your telephone keypad. If you are using a speakerphone, you must pick up your handset before pressing the keys. To withdraw your question, please press star, then 2. At this time, we will pause momentarily to assemble our roster. Our first question today comes from Jeffrey Bernstein with Stonebridge. Please go ahead.
Good morning. First of all, belated congrats on achieving your objectives. But now with capital building up and the softening markets you described, what are your plans to deploy the capital, leverage, and also that you have a security that's callable next month? If you could share your plans with that as well. Thank you.
Sure. Thanks for the question. This is Tim. Let me give you a high-level answer, and then I'll pop it over to Julie to talk about the specific question. We feel no burning need to deploy capital as we build it. We will, over time, deploy that capital. We have set a 2030 strategy. Our capital will be deployed against that strategy. We went from 3 years ago, a little bit light on our rating agency capital with a negative outlook to now an upgrade to A+ from S&P with capital strength. And so you don't make that turnaround in such a quick amount of time and then just start to immediately spend capital. But we will deploy capital, as we've said in our remarks, in a very disciplined manner. We will look for inorganic opportunities that help to fill gaps as we pursue our 2030 strategy. But our primary goal with the capital is organic growth, first and foremost. The next thing I would say is we want to build new capabilities. Everyone's talking about Gen AI and the impacts it's going to have on every industry. We're quite focused on that, and we will deploy capital to make sure that we're harnessing that technology to win and to create competitive advantage so that we can better serve our customers. And so I would say overall, no immediate plans to deploy any excess capital. We will continue to get growth going where it makes sense. We will not chase the market down in the soft market, and we will be prudent in all of our insurance businesses. And we see plenty of opportunities to deploy capital on the asset side of the balance sheet in LMI. I'll let Julie talk more about the leverage in the particular security.
Yeah, thanks for the question, Steph. First on leverage, we've stated that our target range is in the 15 to 25% range. We're at 17.8% right now, so we feel good about where we are with that. As we think about that range, it's really about striking the right balance across having the right financial resilience, liquidity, policyholder protection, and just the flexibility to be able to fund growth and invest in the business. So you've seen that ratio come down over time as our profit has improved and our organic equity generation has increased. But we feel good about that range, and I think you'll continue to see us operate within it. In terms of the hybrid that you referenced, I can't comment specifically on our call intentions there, but what I can say more generally is that when a security becomes callable, we're going to evaluate a range of factors, including things like the economic implications, broader market conditions, and we'll make those decisions in the context of our broader capital management framework.
Thank you very much.
So just to recap, management says there is no burning need to deploy excess capital immediately. The first priority is organic growth to the company's 2030 strategy, followed by capabilities that fill strategic gaps. Generative AI is specifically named as an area where Liberty Mutual may invest to create a competitive advantage and improve customer service. At the same time, management says it will not chase a soft insurance market downwards simply to grow. The leverage answer reinforces the same theme remain within the 15% to 25% range while preserving resilience, liquidity, policyholder protection, and flexibility. Now let's continue with the call. But also before we continue with the call, I completely agree with that. Just because you have the capital does not mean that you just go spend it. So I think that's being very responsible from this management team. That's very, very a responsible strategy in my opinion. Now let's continue with the call.
From Andrew Schiappa with MFS Investments. Please go ahead.
Hey, thank you guys, and congrats on a nice first half of the year. A couple of questions. If I could start with U.S. retail. Personal auto, I know PIF growth was a bit positive, but competition in the space is obviously picking up, and I think you highlighted or mentioned kind of targeted avenues of advertising and growth. Could you kind of shed a little bit more light on kind of where you're targeting in the market? Because at the same time, I think you said kind of reducing the average written premium across the book as well. Kind of help me understand where you guys are looking to compete in the market and how you're winning currently.
This is Hamid. Thank you for your question. I think on auto, we have basically been executing against a pretty clear strategy over the last few years. Our desire has been to build the right portfolio to be able to manage the cycles really well. So really, from a geographic perspective, we're looking to grow everywhere outside of California at this moment. And so our PIF growth, ex-California, as I highlighted earlier, is starting to get into it's 2 points quarter over quarter. I think beyond that, what we've also done is we have defined our go-forward channels very clearly, and they are direct, which includes partnerships and independent agency. And as a part of that, we have transformed our exclusive agency channel into an independent agency. That has a dampening effect on our growth in the moment. But really, we've built a distribution business that delivers really great margins for us overall. So we've created a bit of growth in order to build a resilient channel and really clarified our go-forward channels as the direct channel and the independent agency channel. And then really, what you'll see is we are deploying marketing spend in the right economic way. We have industry-leading media and creative capabilities that we've in-housed. So we feel very good about our spend. And we are really looking to build one of the most recognizable and trustable brands in the U.S. And that's what it's going to be our consistent strategy 2026, 2027, and beyond. So really looking to be disciplined through the soft market, clarified our channels and clarified our geographic footprint. And I think we've taken a lot of the actions to build the right portfolio and be in a position of strength going into the soft market and also take advantage as the market hardens in a bit of time.
All right. I appreciate that. And then kind of shifting over to commercial auto, I think a big decline in net written premium in 2Q. Is that a timing function? I know it's not a focus market and you guys were going to reduce that. But is it a timing in terms of like when policies renew that you're able to take actions that drove that? Or is that a more broad-based approach to reducing that exposure?
Hi there, this is Matthew Moore answering the question. Thank you for it. It's an element of both, but it does absolutely signal a view around our commercial auto strategy. We're very clear in terms of having dissected the book in terms of geographical spread and segments, and seeing that against the background of continued legal system abuse. This is something of a portfolio management tool. So these aren't huge numbers in the aggregate, but yes, it does reflect a very intentional portfolio management strategy.
Okay, and then I'll ask one more and then get back in the queue. Shifting over to kind of GRS, can you shed a little light because on casualty, I've seen net written premium up. Obviously, your commentary is that the U.S. market is weak, ex-U.S. is strong. Can you give a sense of like what the mix of that portfolio that you have is? Like how much of your casualty book is U.S., how much is ex-U.S., just to kind of ballpark it as to what's on the book and what you're writing going forward?
Sure. Ballpark would be 75% US, 25% international. Going forward on a risk-adjusted basis, we'd be looking to increase our international casualty portfolio somewhat, yet we still recognize that we still have ample opportunities where the risk and the pricing makes sense in the United States. So that won't change hugely significantly within the very short term. But yes, our ambitions are that we will, in absolute and relative terms, grow our international casualty portfolio.
Great. Appreciate the closure or the disclosure. I'll get back in queue.
The next question is from Chad.
Man, that man had like 3 questions. So just to recap, on personal auto, Liberty Mutual said is looking to grow across the country outside of California. Its go-forward channels are direct, including partnerships and independent agency. The exclusive agency conversion temporarily dampens growth, but management believes it has produced a more resilient distribution model. The company has moved media and creative capabilities in-house and plans to use marketing spending where the economics make sense. This connects directly to the earlier 1.9-point increase in advertising expense. Commercial auto is different. Management confirms that the premium decline reflects an intentional reduction in exposure based on geography, customer segment, and continued legal system abuse. In casualty, the current mix is roughly 75% US and 25% international, with an ambition to increase the international share over time. Now let's get back to the call. Hopefully this person doesn't have a whole bunch of questions.
Management, please go ahead.
Hey, good morning. Thank you for the call and great quarter and great progress all along. So I'm going to shift the questions over to the investment side. Obviously, a great performance by the LPs. One thing that stands out to me is the unfunded commitments and how quickly that's growing in the private space. Just wanted to get some commentary from you on, how you manage that. Obviously, you have a lot of cash flow that comes in through premium, but it is a big commitment and growing. So any color there would be great.
Thanks, Chad. This is Adam Wynn answering the question. This is an area we spend a tremendous amount of time thinking about in terms of building ample liquidity for the business. I think what you've seen in our actions over the last several years is Vlad mentioned, we're not trying to predict the future, but be prepared for all eventualities. So you've seen a tremendous amount of diversification get built across both our equity businesses, our credit businesses, which will continue. So we really think that we have built in a set of businesses that will kick off cash flow to support future needs.
Okay. Just thinking through that then, I would imagine, if I think through all the detail that's out there in the market about how this all works, you have capital call lines that fund these, investments by funds, and then you would be the credit risk to them, right? So it's high, you're a high quality player, but you're on the hook, right? It is a liability to you, right? And then just secondarily, you've built up RBC a lot. What kind of capital consumption do these types of investments, have for you? I mean, I've looked at the table that you provide disclosure around the allocation of private investments, but part of that's investment grade. Is it clear that anything in the other categories like corporate credit would be a mix of investment grade and non-investment grade, or do you classify those as below investment grade, which would therefore consume materially more capital than investment grade?
So thanks, Chad. I think there are a few questions there. Maybe I just take it up to a higher level. So we have many forms of liquidity and build in a tremendous amount of redundancy. This is both done at the LMI portfolio level and above that. The capital call lines you're referring to, to the extent we have general partners who are using those lines, we don't factor those into it as a source of our own liquidity. We assume that we are going to fund all those obligations. We do extensive stress testing around, worst of type situations that occur across the entire investment book, where we, build redundancy to be able to fund across all those items. And then further, we have an extremely integrated liquidity management practice across our book where, we have substantial portion of our assets are liquid securities. We build our book in a way where we don't want to disrupt the investment strategy of those liquid securities, meaning that there's even redundancy built into our modeling. So, and I think your last question was just in terms of capital charges. The preponderance of what we own is investment grade. But because of the diversity of our book, we do own assets out to venture capital where we're having very high capital charges. But it's hard to generalize. Although we look through to the underlying credit exposure and asset exposure, and capital charges aren't drive what we're doing. What we're doing, it's more of a where do we think we can generate attractive risk-adjusted returns within a well-bounded risk framework that I think is well understood.
Okay, that's great. I'll jump back in the queue.
The question here is whether growing private investment commitments could strain liquidity. Management says it assumes it must fund the commitments itself and does not rely on a fund's capital call credit line as a source of Liberty Mutual liquidity. The company says it stress tests the portfolio, maintains substantial liquid assets, and builds redundancy into the liquidity planning. Most of the portfolio is investment grade, although some venture and private equity holdings carry higher capital charges. The takeaway is that private investment may boost returns, but they also create timing, valuation, and liquidity risk. Liberty Mutual says the decision framework is based on risk-adjusted return, not simply minimizing regulatory capital charges. Now, let's continue with the call.
Next question is from Dell Anderson with PIMCO. Please go ahead.
Thank you. Some of my questions have been addressed. Congrats on the capital build. It really has been impressive over the last several years. I am interested to see what you do with it. Following up on Chad's questions on the private investments, you had mentioned there had been some IPOs. Maybe just get a little bit into the sectors here. Are these like SpaceX or some other like technology? How active is Liberty Mutual in data centers and AI type equity investments? Just so we can get a sense for what's driving the much stronger alternative performance for you guys versus some of the life goes that have reported the last couple of days.
Yeah, thanks, Del. This is Adam again. So I think I'll go back to, we've really been building a lot of diversity across our equity book. So what you're seeing now, if I had to overly generalize, is strong performance coming from our private equity book, namely in the venture space, and there's several names there. And then correspondingly, our digital infrastructure book, which is part of our energy and infrastructure business, has also had some exits which have been positive. Again, our underlying strategy, and this ties back into the prior question, is that we want to have businesses that do well through the cycle and have are kicking off liquidity and have exits at different points in time. It happens to be at this moment we've had a number of exits, but these are really 5 and 10 years in the making. And so we look through and try to invest for a longer time period.
And you're not able to disclose individual investments, some of the names that we might recognize.
Yeah, sorry, not at this time.
The next question is from Chris Santos with Morgan Stanley. Please go ahead.
Thank you for doing this call, and congrats on the S&P upgrade. I was just wondering if you have any longer-term ratings target to see, or are you pretty content with the A+ from S&P? And as a follow-up, can you just talk about your funding needs for the next 12 months? Thank you.
Hey, Chris, this is Julie. So thanks for the question. So we are pleased with the S&P upgrade to A+ and the recognition of our improved underwriting performance and in capital management. That said, I'd say the upgrade doesn't change our long-term strategy or the way we're managing capital. We still continue to focus on protecting our policyholders across stress scenarios, preserving financial flexibility, and growing tangible book value over time with an appropriate level of volatility. So we view the strong ratings as an outcome of all of this, of the disciplined underwriting, our balance sheet strength, and prudent capital management, as opposed to managing to a particular rating. In terms of funding, we have robust sources of liquidity. Our cash from operations remains strong, and so we feel good about our ability to continue to operate with the right level of liquidity and making the right investments.
The next question is a follow-up from Andrew Schiappa with MFS Investments. Please go ahead.
Hey, thanks for letting me get another one in. You disclosed a pretty big subsequent event with the $1.5 billion out of Venezuela. I know it's relatively new, but can you maybe just kind of go through what some of the next steps are that you'll be able to potentially pursue collection there? I know you won't have specifics or any kind of specific timing, but just kind of help us understand what the next steps are, because that's a pretty sizable number there.
Yeah, thanks, Andrew. I can't give you a ton more detail than what we've disclosed. This is, just came out last week, actually. So overall, what I can say, though, is that we're pleased with the tribunal's decision because it has been a multi-year process. As we disclosed, the matter will take time to fully develop, and so there are a number of procedural and legal steps that we need to go through. And then, of course, we'll align those with the accounting considerations to be able to recognize it appropriately. At this stage, I think it's premature to be able to comment on anything that might be recognizable or not. So stay tuned. Like I said, we think it is a positive development. There's several more steps to go, and we will continue to disclose if there's anything material.
And what was the arbitration around?
So this goes back to
the origin of it.
Yeah, sure. This goes back to we historically had a Venezuelan operation that was an operating insurance company, and given the hyperinflationary environment and the overall environment, we essentially had to write it off. And so there was value there that was essentially written off in a way that we disagreed with. So I'll leave it at that.
Got it. I recall that. Thank you.
Again, if you have a question, please press star, then 1. The next question is a follow-up from Chad Stogel with Spectrum Asset Management. Please go ahead. Mr. Stogel, your line is open on our end. Perhaps it's muted on yours.
Thank you for that. Sorry about that. Thanks for taking the next question. Just looking at some of the growth in credit lines growing, I'm just wondering, there was some press around another mutual insurer wrapping, private credit vehicles to get them higher ratings. Was wondering if that's something that you've looked at and how you frame that risk.
Hey, this is Adam Wynn again. So I think, we're aware of some of that activity in the market. This is speaking from an investment perspective. That is not something that we've been actively pursuing in any size that I'm aware of.
Okay, no, that's a good clarification. Thanks for that.
Mr. Peach, it appears there are no further questions at this time. I'd like to turn the conference back over to you for any additional or closing comments.
Great. Thank you, Gary, and thank you to everyone for joining.
So let's recap the final questions before we get into the end of the call. Management says recent private equity and digital infrastructure exits were the results of investments made 5 to 10 years earlier. It does not disclose the individual companies involved. On financial strength, Liberty Mutual says the A+ rating is an outcome of underwriting and capital discipline, not a standalone target that changes its strategies. Finally, management says it is not materially pursuing structures that wrap private credit vehicles simply to maintain higher ratings. That closes a call defined by strong profitability and substantial capital and a consistent warning against chasing growth without sufficient returns. Also, at the end of that, they did start talking about the Venezuelan ruling they got. So they did kind of touch on that, but they really didn't give like any really final numbers or final things that were involved in that, because it is ongoing or kind of like wrapping up the litigation. So they're not going to disclose that. So that kind of was all the question and answers and the end of the question and answer section. Let me just check my notes and make sure I didn't miss anything on that before we hear just the end of the call and the wrap up. Yeah, it looks like I got everything. So we'll go ahead and hear the end of the call, the wrap up of it.
If there are any additional follow-up questions, please feel free to reach out to Investor Relations directly. Our contact information can be found on the Investor Relations portion of our website. Have a great day.
The conference is now concluded. Thank you for attending today's presentation. You may now disconnect.
Okay, so that there was nothing else there. So here's my final assessment. Liberty Mutual's Q2 and first half results are genuinely strong. Quarterly net income increased, the total combined ratio improved, catastrophic losses were lower, personal lines underwriting was highly profitable. The balance sheet strengthened and S&P upgraded the company to A+. For consumers, the call suggests more competition and targeted growth in personal auto and homeowners insurance, especially outside of California. That may create shopping opportunities, but it does not promise that every policyholder's premium will fall. For independent agents, Liberty Mutual's continued commitment to Comparion and independent agency distribution confirms that advice and choice remain part of its growth strategy alongside the direct channel. If today's Quick Bite episode helped you better understand Liberty Mutual's second quarter results and what those results may mean for auto insurance, homeowners insurance, and insurance agents and consumers, then that is exactly what I hope to accomplish. Insurance company earnings calls often reveal where carriers plan to grow, where they may reduce exposure, and how they are responding to claims trends, and which expenses could influence future insurance rates. Liberty Mutual reported strong profitability and lower catastrophic losses, improving policy growth, and a stronger balance sheet. However, its higher underlying combined ratio, increased advertising expenses, liability claim severity, and continued concerns about legal system abuse are important trends to continue watching. If you currently have Liberty Mutual insurance or your auto or homeowners policy is approaching renewal, no matter who you're with, review your coverages, deductibles, discounts, and available alternatives before automatically renewing. If you would like to review your current policy or request an independent insurance comparison, please visit our website at www.isominsurancegroup.com. That's ISOMINSURANCE.com. Oh, group, GROUP.com. Again, it's right there on the screen, right below me, right below me. Preparation always beats regret. Understanding the numbers behind the insurance market can help you make better coverage decisions. If you found this episode educational, please like this video, share it with a friend, and drop a comment below answering today's question. After hearing Liberty Mutual's Q2 results, which issues matter most to you? Insurance rates, claims costs, artificial intelligence, or being able to use an independent insurance agent? Remember, Quick Bite episodes now drop every Saturday at 2 p.m. Eastern. This video is for educational purposes only and should not be taken as legal, tax, or specific insurance advice. Please consult a licensed insurance professional regarding your unique situation. This is Roshonda with the Isom Insurance Group here in sunny Florida, and it's been really, really hot. Thank you for watching. I hope you have had a wonderful and safe weekend. I hope you have a wonderful and safe weekend, the rest of it. And I will see you next Saturday for another Quick Bite episode. Stay safe out there. Bye.